Hello, everybody, and welcome to today's webinar on smart ways to save for education. This webinar is hosted by Saving for College, and it is sponsored by Rowe Price 529. Happy 529 Day for everybody. It's a day early, I know. But our special industry holiday is going to be tomorrow, but I guess we're kind of celebrating it today. And we have a really good program for you set up. So first of all, just to introduce myself, I'm Scott Morrison. I'm the head of product here at Saving for College. I've been fortunate enough to be in the 529 industry for most of the last 20 years, and I've seen it grow and change. It's been a wonderful experience for me in my working career. And our featured speaker today from T. Rowe Price is Roger Young. So Roger, if you could introduce yourself and we'll kick it off here.
Sure. Yeah, I'm Roger, and I'm a director of thought leadership here at Rowe Price. So I help formulate our perspectives on various financial planning topics. The topic of saving for education is near and dear to me. So I love doing these type of educational events. So happy to be here.
Great. Thank you, Roger. Okay, so let me get started here by just introducing today's sponsor, T. Rowe Price 529. For 25 years, T. Rowe Price 529 has been helping families save for future education expenses in a tax-advantaged ways in all 50 states. This plan is highly rated by Morningstar, received a gold rating in 2025, highlighting their commitment to helping families invest in the future. In celebration of their 25th anniversary, T. Rowe Price 529 and the Education Trust of Alaska have introduced the T. Rowe Price 529 Account Momentum Program. Individuals who open and fund a new T. Rowe Price 529 account with at least $250 before December 31st, 2026 will be eligible to receive a $250 incentive contribution in February 2027. The program offers a valuable opportunity for families to add momentum to their education savings. So, sounds like a pretty good offer if you're interested in opening an account for $250. All right. In addition to this being one day away from 529 holiday, we're also this year celebrating 30 years of the 529 plan being in existence, having been started in 1996. And the name, of course, comes from Section 529 of the Internal Revenue Code. So you can see in this twisty map of ours here that over the years, 529s have changed and they've expanded. I mentioned my longstanding time in the industry. I joined in 2002 and the market was a mere $20 billion, and today it's over $600 billion. So it's clear that people have voted with their dollars and they put their trust in these vehicles. They have proven to be very, very successful. So, Roger, I think it would be a great time for you to add some thoughts into why 529s have become so popular and so successful.
Well, as you look at this graphic, there's a lot going on here, but I point everyone to 2001, where it describes that in 2001, qualified withdrawals from 529 plans became tax-free. So that was a change from the way it had been. And that's a huge benefit. So taxes are a large part of what we're talking about in terms of the benefits of 529s. And the that tax benefit, if you perhaps save for retirement in a Roth account, you might feel like it's somewhat familiar to you in that you don't get a tax benefit up front in terms of the federal taxes, but then you get a great benefit at the end when you take the money out, which is, again, qualified withdrawals are tax-free. And you can see also on this page, there are a whole lot of references to qualified withdrawals or qualified expenses. So over the years, more and more things have been eligible so you can get those qualified tax-free withdrawals. So a lot of great things have happened over the years, and even just in the last few years, a few significant improvements to the tax benefits of a 529.
Right. And we will talk about those as we go through the slides here today because it has expanded a lot over the years. Um, Okay, before we move forward, actually, I forgot housekeeping items up front. I should have said it up front. You will, this session is being recorded. You all will receive a copy of this in a link in an email that will go out afterwards. That same email will include a short survey, and if you want to share your thoughts, we would love to hear your thoughts on it. It helps us at Saving for College improve our webinars every time we present them. So please do that. And then finally, the Q&A box is open. So if you do have questions, I see there's been a couple people raising their hands. Put those questions into the Q&A box, and we will try to pick them up and answer them as we go. So make this interactive as we go along. Okay, thank you.
Great.
All right, so let's start here at an overview of 529 plans. What are they? How are they created? What types of investments are in them? Are there any pitfalls associated with 529 plans? This is kind of our framework that we're going to be using here as we step through the presentation. So let's start off first of all with who offers 529 plans. There are actually over 100 529 plans right now within the U.S. They're offered by 49 U.S. states and one jurisdiction, the District of Columbia. The only state that does not offer one is the state of Wyoming. Everybody else has at least one plan. Some states have multiple plans. They have a direct sold plan and an advisor sold plan. But as soon as we start talking about a state, I think that raises questions, Roger, with people about, okay, so my state has one. Do I have to go there? Does that limit where, my kid goes to school? Can you just share a little bit more detail about, about how they work?
Sure. And you see on the screen, you're definitely not limited to using your own state's plans. Now, there are excellent reasons for choosing your own state's plan, primarily the fact that a lot of states will offer state tax benefits. But the next follow-up is, well, do I have to send my kid to school in state? And just to be clear what we're talking about here, we're talking about the 529 savings plans. Some of the people listening may be familiar with prepaid tuition plans. That's not really what we're talking about today. We're talking about the savings plans. With those prepaid plans, there could be advantages to staying in state, but with 529 savings plans, no. Anywhere you want to go, you can take the money out and it's still qualified expense if used properly, and it's tax free. So the way to think about it when you're setting up an account is you do want to look first at your own state's plan, see if there are benefits, compare plans, see if you like the features of your state's plan, see how the performance has been over time, how good the customer service is, all of those types of things, what the expenses are. But you might lean toward your state plan if it offers a tax benefit. There are also some states which offer tax benefits, but you don't have to put the money into your own state's plan, and that's called tax parity, where you can get that tax benefit regardless of which plan you contribute to. So, probably about 9 states offer that. So
Nine.
do look at what the different state rules are. I think that's important.
Yep. That's a great summary, Roger. The other thing I will mention is that you've got a choice of investments as we talk on to investments, and one of the key things that's important about sorry about this about 529 plans is that they're actually not guaranteed programs, right? We talked about the fact that they're investment programs and they can go up and down with the market. So.
Yeah. We like to talk about the tax-free growth, tax-free potential growth. I think, historically they've done well, but yes, you're absolutely right to point out that they're not guaranteed investments.
Right. Okay, so let's move on to contributions and how and when you can contribute, who can contribute. It's an important aspect of 529 programs. 529 plan, it's different in some ways than some investment accounts. It has a structure with an account owner who is a person who's able to, make the investment decisions for the account, a person who's at least 18 years old, typically in the state, and then a beneficiary who is usually a child, but doesn't have to be a child, right? That's the usual structure, but there's actually a lot of flexibility around 529s in general. Can you, extrapolate on that a bit?
Sure. Yeah, I think that the common application would be a parent opening up an account. So the parent's the owner and the child is the beneficiary. But we get a lot of interest from grandparents and other family members, and they typically have a few options. They could start up their own 529 account for the benefit of their grandchild, as an example. And then they would have the control over that account. Or a grandparent could make a gift into an account set up by the parent. So a number of ways, and increasingly, 529 plans are offering gifting portals or nice administrative ways to make it easy for people to give gifts. You might even see a request, in lieu of toys for this holiday or birthday, contribute to Billy's 529 account and make that easy. And you don't have to give out the account numbers. The plans make it easy to execute that. So yeah, lots of ways that money can get into the 529 accounts. And we'll talk a little bit more about some of the benefits, but as a grandparent, it's it's actually quite advantageous to have money in a grandparent-owned 529, which it didn't used to be that way, but now that's a really nice way to go.
Yeah, and I will echo that sentiment, Roger. I think we can see from our dealing with 529 programs, et cetera, for college, grandparents absolutely love to give to 529 programs, and these gifting capabilities that most of the platforms offer out there for in terms of the 529 record keepers makes it really easy to give, and you don't have to give away your account number. You can give, a code or a link to somebody, and they're able to give. And lots of times that's, out of a bank account or even by a credit card. So there's lots of, very flexible ways to continue to grow the balance.
Yeah.
Um, the other thing, you see at the bottom here, we're saying there's no limits on age, income, state of residency. You can actually open a 529 for yourself if you wanted to. And there's going to be some good reasons that we'll touch on later in the presentation about why you might want to do that because of the expanded uses. Um, Also,
Maybe
there's
I'll add
there,
one more thing, Scott. Oh,
yeah.
sorry. In terms of the limits on income, it is worth noting, I mentioned earlier that these can be kind of like a Roth account, but with a Roth, you have to have earned income and you can't earn too much to contribute to a Roth IRA, whereas those limits don't apply here. So it is fairly flexible. And you can put a lot of money into a 529. They're capped in terms of the total you can accumulate, but on a yearly basis, it's pretty flexible.
Yes, and just to reiterate that most states are above, the 400,000 or $500,000 level in the limits of contributions that you can put in for a single beneficiary. So you can sock away a lot of money here, and there really is not too many limits involved with that.
Yep. Mhm.
Okay, there's a couple questions that have come in I want to address. I saw them come into the chat. Somebody asked if we were going to talk about guaranteed savings plans today. No, we won't be focusing on those. We're focusing on investment 529 type programs. A couple of there are not too many prepaid plans out there, the largest being in Florida and Pennsylvania, but they're kind of a minor part. So we're focusing on investment plans today. Another question somebody asked, Roger, was there was a mention of the state tax benefits, and somebody asked, are there also federal benefits in addition to state? So maybe if you could explain, the benefits you get at a federal level. So.
Yeah, so at the federal level, again, you don't get a deduction when you put money into a 529. You get the benefit of that potential growth being completely tax-free if you take the money out for a qualified expense. Whereas with the state benefits, typically it's more of a deduction up to a certain limit, state by state, for money that you put into the 529. And then there are typically rules about how you use it, and they might, claw that back is the expression. Not a great thing to have to happen, but if you don't use it appropriately, they might, insist that you give back some of that benefit. But again, if you're using it like most people do for legitimate college or educational expenses, then you don't typically have to worry about those.
Hmm. Okay. And I'm seeing another question. If grandparents open a 529 account, who should be the beneficiary?
Okay. I mean, generally, the beneficiary would be the child.
Hmm.
I've heard people say, well, if we have multiple children, should we just open up one account for multiple children? Um, I think there are good reasons to open up separate ones for each child, including, something we'll talk about later with the possibility of rolling money at the end if you have a little left over into a Roth IRA. It's nice if you've set it up with the multiple beneficiaries for that purpose. So yeah, you generally, make the beneficiary the person who you ultimately would like to benefit from the account.
Hmm. Okay. And I had another question about whether an LLC or an S corp could contribute to a 529. Employer contributions. Maybe just touch on that quickly.
Yeah, I think that you can have an employer contribution, but in that case, that contribution, I believe, would be considered as income
Hmm.
to the employee. So I wouldn't say that that's necessarily a common thing, but it's possible.
Yeah. Yeah. Okay. Well, let's dig a little bit more into the investment options that are available. We know that the 529 plans in general. It's very common for folks for this to be maybe the only investment product that they have, other than maybe their 401k at
Mhm.
work. But I think what they'll find is that it kind of the investment options that you see if you open the door on your 401k or open the door on your 529 program are actually quite similar. So could we dig a little bit into that and maybe talk about investment selection and what's out there to actually even make it easy for people to invest?
Sure. So you'll have a menu of options with a 529 plan, and that is somewhat akin to a 401k plan. And you mentioned here, mutual funds are generally the investment options, and that's the case for a lot of 401k plans as well. And then the third item here, we talk about enrollment based or age based options. So kind of like you can put money into your 401k based and have it invested based on the time between now and when you're planning to retire. So, a target date type of product. And with the 529, it's a similar idea. It's matched to the timeline that you have. So the date of enrollment potentially for your child, the beneficiary who's going to benefit. And so over time, that would become more and more conservative. So by the time you get to the college age, it's relatively protected. And again, not guaranteed, but less investment risk with fixed income bonds and cash as you get closer to the college age. So I personally have found that that's a very nice option to have. It makes it easy. You don't have to do a lot of changes over time. You're limited in the changes you can do. So it's nice that they've set it up so that you have this automatic path toward a more conservative investment profile over time.
Okay, great advice. Getting a good number of questions out here. Thank you to the audience for these. Some of them are very complex, and I won't dive into those. Maybe we can handle those at the end.
Mhm.
But there are some general questions. Somebody asked, can more than one person open a 529 for the same beneficiary?
Yes, yes, certainly that's possible. Yep.
So
Um,
it's possible to have parent and grandparent.
mhm.
There's other questions as well that we will handle going forward. Some people are asking about the impact on financial aid,
Mhm. Get
and
there.
talking about rollovers to Roths. We will get there, everybody. So just
Mhm.
keep that in mind. We've got more material to cover here, but thank you for your questions. Keep them coming.
Mhm. Good.
Okay. So, Roger, this sounds like a really great rosy picture, right? You get
Mhm.
capability to have tax deferred income. When you take it out and it's qualified expense, you get to take that out tax free. There might even be a state tax advantage to contributions. Well, there's got to be some kind of catch, right? Where's the catch here? Where are the pitfalls?
Yeah.
We put a few things down here, and if you can comment away on these, we'll all learn together. So,
Yeah, I mean, the big catch is, they're intended to be used for education. So if you don't use them for education, you can be subject to taxes on the growth, as well as a 10% penalty on the growth, those earnings, not the money you put in, but on the earnings portion. And so, yes, we do get questions like this. What if my child doesn't go to college? I saw flash up a question from someone about, beneficiary who, has had some bad turns in life and not as likely to go to college. Or, on the flip side, they, get a full scholarship, or they're, maybe everything goes fine and, the account's done well, there's money left over. So I would say the key points to all of these are there is a fair amount of flexibility, both in the types of expenses. You can also, very importantly, you can make a transfer of the beneficiary. You can switch it from one of your children to another child or a different relative, or even yourself if you think you might use that money down the road for continuing education and other qualified expenses. So a good amount of flexibility there. Specifically to the scholarship question, if you take out money that is, basically the same amount of money that your child got as a scholarship, that money you would be taxed on it on the gains, but you wouldn't face the 10% penalty. So in that sense, it's kind of no worse than a non 529 type of investment account. So big picture, we don't see a lot of people accumulating tremendous amounts of money in 529s that they just can't use in some way for educational expenses. I suppose it happens, but very few people say, wow, I really wish I hadn't put so much money into a 529.
hmm yep, I'd agree. You don't see that regret too much. So, um, okay, so I'm also seeing a number of questions here amongst our webinar attendees on qualified expenses, and the if you look at this chart, so we talked about the 30-year history of 529s. When they were created, only college tuition was covered. And then in 1997, they added in room and board, which is on this chart. But everything else that's on this chart, Roger, has been added 2015 or later. These are all expansions that have been added since then. So there's been a real expansion in the use of these qualified expenses. I actually had a question from somebody here that says, how should I track qualified expenses? How should I do that? And do you need to do that? Um, and
Yes.
yeah, and
Short answer, yes.
yes, the answer is yes. It's not something when you use the money that you need to say, here is what I'm planning to spend this money on, but you need to have it if the IRS comes back to you and says, what did you use that $10,000 disbursement from the 529 for? So,
Yeah.
but yeah, if you could comment on, this expanded list of expenses here, which really opens up what you can actually spend $529 on in a qualified way.
Yeah, I mean, I think some of these are nice in that they're not traditional college, apprenticeships, certificate programs, licensing, continuing education. I saw a question pop up, and we didn't put this on the slide, but student loan payments, up to a certain limit. Not all of them necessarily, but up to a limit. And a lot of these things have limits to them. But yes, again, a variety of things, including the K through 12. It's generally for tuition. But that number has been doubled from initially 10,000 to 20,000. So a lot of flexibility. I think it's nice if you can keep the money invested for the longer term goal of college compared to K through 12. But if you're midway through sending your kid to private school and you realize it's difficult, or maybe this is the end of the educational road for them for a while, then certainly take advantage of the K through 12. I will make a quick comment on that question about kind of the logistics and the record keeping. I will say, I'm a finance guy and understand taxes pretty well. It was always, when my kids were in school, it was one of the more complicated parts of my tax return. So not to scare people off, but you do need to pay attention. And one thing I would advise, at least for me, it worked out well that I had the money come out of the 529 to me, and then I paid the school or I paid the rent in the case of off-campus housing. And that way I had a very, clear, record of all of that. So just one thing to think about. Yes, you do need to keep track of it.
Yes, yes. And just to follow up, you did mention the use on student loans, and actually that was a question that was in the chat. That's currently maximized at $10,000 lifetime for beneficiaries. So that's a one of the tighter caps. I think with all of these things, what tends to happen over time is the caps can move up a little bit on what you can spend it on. But I think again, it's probably all part of the mantra that it's better to save in the 529 than to have to take a lot of loans out anyway at the end of the process. So,
Absolutely.
but yes, these are definitely all good qualified uses in terms of 529s. I see some questions popping up about rolling over and hey, I thought after 15 years you can roll it over to an IRA and can I do that? That's our last item here. But we're just going to move on to talk a little bit more detail about it because the Roth IRA rollover is one of the newest provisions. But there are some strict limitations in terms of what you are limited to here. Um, I guess the way that I think about this, Roger, is this is not some shortcut on a way to start your own retirement, right? To find a way to funnel it through a 529 and get a Roth IRA out of it. This is really meant for truly leftover money for somebody that's been saving for a long time, right? So if you could comment here on this list of items.
Yeah, I think that's a good way to think about it. Yes, it's not some magic bullet, but it's a good thing to have for that extra money. And you see, a fairly long list of requirements, but it needs to be for the beneficiary. It has to have been opened 15 years ago, and the money that was put in has to have been at least 5 years ago. So they don't want you just putting money in at the very end of, the time you're spending money on college and then immediately roll it into, Roth IRA. That's prohibited. There is that lifetime limit of 35,000, and importantly, annually it's limited to the Roth IRA limit of 7,500. And when we say that limit still applies, there's also the limitation that the beneficiary who's getting this Roth IRA money has to have earned income. So typically, the way that you would envision this is they get through college, you have a little bit of money left over, they start a full-time job, they have significant, work income. That's when you can move that up to $7,500 per year. So over the course of several years, do up to that 35,000. Importantly, the last item on this list is you can't just have the 529 cut a check to you and then put it into a Roth IRA. It has to go directly. And that might be familiar to some of you in terms of other types of, IRA transfers and rollovers where they have a, excuse me, a similar type of restriction. So not difficult to do, but just remember, you can't have them cut you the check.
Right. Good advice. And we are seeing, there was just a NAST webinar that we had, and one of the topics was how popular is this provision? Well, the number of people actually who are doing this has increased kind of 100% year over year since the first year of it in 2024. So we are seeing people making good use of this if there is money left over. Um, and I know it was a long time kind of hesitancy as one of the reasons to not put money in because you didn't know what you could do if there was money left over, and apparently people are using it. So so it's working out to be quite a good provision, I think.
Yep.
There are some questions about what if it's your lifetime, what if your total 529 balance is over the 35,000? What do you do with the extra money if there's over there? I guess that probably speaks to the flexibility, I guess you have with the beneficiary change, Roger.
Yeah, I'd say in that case, yes, you can change the beneficiary to another family member. If you're a really kind aunt or uncle, it could be to a niece or a nephew, or to yourself. And that gives you, there's no time limits on some of this. So you could give it, change the beneficiary to yourself have it there in case you need it for continuing education or a grad program at some point. So yeah, again, not to say there aren't chances that you would pay a penalty, but if you're smart about how you put it in over time and you keep track of what is the likelihood of my child going to school, and you aim for a percentage of uh, the sticker price as opposed to trying to fund it all through a 529. Well, then it can be a very useful tool, and you can save the rest of the money in different ways and look for other sources of income for your child. So yeah, don't oversave, but again, we don't see that problem too often.
Yeah. And somebody asked, I think a question that comes up a lot with the Roth IRAs is, does changing the owner and beneficiary reset the clock for the rollover to Roth? I think that's your hands are up in the air, my hands are up in the air. That's the answer that we don't know. I will say that that is a question that the industry has asked of the IRS, and the IRS has not given a formal answer on that yet. So it's kind of a gray area. So I would say, rely on your professionals, your financial advisor, your tax advisor in terms of the course to take there, because
Yeah.
it's not clear.
Yeah, and if you have to hold tight for a while, hold tight and let the money grow and see what happens, right?
Yep. Yep. Just a couple other questions before we move on to the paying side of things. There's a question here about can you have joint ownership of a 529? No, really, the structure is single owner, single parent, or sorry, single owner, single beneficiary, and that
Hmm.
owner can be, typically it's a parent, but it can be a grandparent, an aunt, an uncle, family friend. It doesn't matter, but there are no such joint accounts. It is essentially one to one. But
Yeah,
we
you
did
can have a
mention that
successor owner.
you can
So
have a successor. You can have a successor owner as well. And actually, that was a question that was asked as well. Somebody says, "What happens if a grandparent should pass away?" Successor owner is the person that you name who becomes the new owner. So the minor does not become the owner at that point in time. So there is a real lot of flexibility with this product.
yeah,
Okay, we're looking here at paying for college. So we've done all this great savings, and if you're opening a 529 account when your child is born, you're going to be saving for 17, 18 years. There's a time where you got to pay out, right?
yeah,
There's been a few questions here about, hey, how does that affect my financial aid? I've heard that kind of as a myth out there that could prevent me from getting a maximum financial aid in some way. But I think as this page shows that that's not the case, right, Roger?
yeah. I mean, I think we have to acknowledge that there is an impact on the financial aid calculation, right? You can see that we talk about up to 5.64% of the assets that you have in the 529 for that particular child going to school that you're filling out the FAFSA for. That will be applied to your student aid index number. People might remember the old term, the expected family contribution. And that is kind of a baseline for what you as a family are supposed to fund. And a college or other source might give grant money to help you meet that gap between your student aid index number and the sticker price. A few thoughts on that, though. One, schools don't necessarily give aid equal to that full gap, that full need. Even if they give money to help you meet that need, it might be in the form of loans. So again, the situation where it's not going to one for one reduce the amount of aid you get. That's first and foremost. A small fraction of it could reduce the aid, and it might just be shifting it to loans. So I think it's a bit, I wouldn't call it a myth, but I would say it's perhaps overstated the concerns about saving for college. And, regardless of how you save for college, whether it's a 529 or just a savings account or a brokerage account, anything other than say a retirement account, those will all apply to the financial aid calculation. So it doesn't put you in a disadvantage relative to other vehicles. And I guess I'm somewhat passionate about this because of the thing you don't want to have happen, right? What you don't want to have happen is you have a high income as a family, which is going to drive that student aid index and drive the aid calculation, and you have made the mistake of not putting money away for college because you're afraid of not getting financial aid, you really don't want to be in a position of high income and low savings. That's a tough spot in terms of when it's time to pay for college. So I'll leave it at that.
Okay. I'm seeing some questions come up on this topic here. One that just popped up, it says if a parent becomes a successor owner of a 529 that was owned by the grandparent and now the child is applying to college, is that considered student or family income? I think the answer to that would be yes, because now the parent is the account owner, right? And that is a parent asset.
Well, parent asset, but not parent income. And
Right,
so
parent. Good point.
and so yeah, parent income is has a much larger effect on the aid calculation than parent assets. Student income and student assets are counted very heavily. And so it is a nice thing that this is not counted as a student asset or student income. And we talk here on the slide about the grandparent thing we mentioned earlier, where it used to be that money coming out of a grandparent 529 would be counted as student income. That was not good for aid purposes. Now that's not true anymore. And so in fact, it kind of flips the situation where that grandparent 529 isn't counted at all in the calculation. So it's an advantageous way to have, as a broader family, saving for college, saving for
Hmm.
education.
Yep. I'm also getting a number of questions in the Q&A about older students. And, my student is a year from becoming a high school senior, or might actually even somebody already in college. Is it still okay to open a five? Can I do that? And is it still okay? I mean, I
Short answer,
know,
yes. Yeah.
yeah.
And longer answer, I used to tell people, once you get really close, you're going to want to be somewhat conservative in your investments, right? In a 529. And so back, 5, 10 years ago, when interest rates were super low and you couldn't make a whole lot of money on a conservative investment, I would say, maybe it's worth it, maybe it's not. I would say now, if you are in a better position to afford to put money away for college, yes, go ahead and do it. Even conservatively, there are some investments that can earn you some money, and that those earnings would be tax free. So
Mhm.
much better situation for those families than even 5 years ago.
Yeah, and I will add to that you can still get a state tax deduction benefit if you're contributing, even while a student is in college. I would be careful about that. I would check your state tax rules or check state saving for college for what the current rules are, because there are a couple of states that are saying you can't put it in and then take that out, 4 months later and get a tax deduction on it. I think there's a handful, probably less than 5 states that are doing it. But in most cases, you can actually contribute in one year, and then if you wanted to take the money out the next year for college and benefit at least by getting a state tax deduction on those contributions. So it still does offer some benefits at that point.
Yeah, and from a
Okay.
federal standpoint, I believe you can put money in and take it out, fairly short term, and that's not
Yes.
an issue.
Yes, the federal part of it is definitely not an issue. Yeah, it's just the availability of the state tax deduction.
Yep.
And then, so before we move on to the next one, there's also a question about super funding. Somebody asked about supercharging their child's
Hmm.
contribution. Congratulations that you're able to do that. What's the maximum contribution as a married couple? And this is going to fall into,
Yep.
I imagine, the gift tax of 19,000 per year, right, Roger? But you can
Yes.
definitely supercharge that if you think ahead.
Yeah. So for most mere mortals who don't have that capability, you'd want to generally stay within the $19,000 per year limit. It's not a hard limit relative to 529s, but it's the limit that you can give as a gift in a year and not have to file a gift tax return. Okay. So it's nice to stay under that $19,000 limit. There is a special provision relative to 529s where you can do 5 years of that. So 5 times the 19,000, right? So what's that, 95,000 if I'm doing my math right?
95,000. Yep.
And you can do what's called a split gift with you and your spouse, where you each kind of agree to combine forces on it. And so you could do twice that much for a beneficiary. So you could do 190,000. And if you have multiple kids, you could do 190,000 per kid. And then what you're agreeing to do is then not put any money in over the next 4 years, right? So it's taking up that 5 years worth of the gift tax exclusion. And I jokingly say there aren't too many people who are in a position to do that. But if you're a very uh, in a very good position, it's a nice thing to do, and you'll probably hear estate experts say that it's a nice thing from an estate standpoint. It gets the money out of your estate, yet you still have control, and that's kind of an unusual combination in the world of estate planning. So yes, it is a nice feature if you can do that.
Yeah, and the last part of that question was, how does that affect when we file the FAFSA or anything like that? It actually doesn't have any effect, right? There's no inquiry into how you put the money in the 529. It can be all at once. It could be a regular contribution every month if that's the way you did it. So
Yeah. So I mean, yes, that money would count. The asset level would count toward the parental assets in the FAFSA, but yes, not any more or less than any different way that you put the money in.
right. Okay, moving on to our last topic here before we get to Q&A. And I think it's an appropriate day to be presenting this because actually today is the launch day of Trump accounts out there, even though they're going live from $1,000 free money standpoint on July 4th. They actually just launched the app for the Trump accounts yesterday. So that is on the street. So this has been a provision of the one big beautiful bill last year that has put a lot of focus on child savings accounts, and a lot of people are hearing about this. There's supposedly 5.5 million people who have signed up to open up a Trump account already. Um, but they're really not designed to be, optimal for education, right, Roger? I mean, there are a lot of differences and quirks between the two, and it'd be great to kind of go through these and show folks that even though it's a great way, another great way to save money, it may not be where you want to put your education savings, right?
Sure, I think that's a really good way to summarize it. That a Trump account is treated like a traditional IRA, and in fact, the money you put into it would be essentially like an after-tax, non-deductible traditional IRA contribution. So it's intended to be very long-term money for that child. So like an IRA, you couldn't take the money out at all. Well, actually, this is a feature specific to the Trump accounts. You can't take the money out at all before age 18. And then even after that, up until age 59 and a half, there are a lot of restrictions. There are some exceptions to the penalties and taxes, including certain educational expenses, but it's a lot less designed for education than a 529 plan is. I'll also highlight here the second line that, the limits, the no real limits for 529s and a fairly tight limit for Trump accounts. And the third line is important. The taxes are somewhat complicated for a Trump account, depending on how the money is contributed. And any way you look at it, the money that you put in to a Trump account yourself, some of that money, the earnings portion of that money, when it's withdrawn, that's going to be taxable, as opposed to the more Roth-like treatment for a 529 plan, where, again, as we've said a few times, all withdrawals for qualified educational expenses are tax-free. So a significant tax benefit and tax complication benefit for the 529 versus the Trump account when it comes to spending for educational expenses. And maybe if you flip to the next page, um, if we expand on it just a little bit, again, there are penalties for both. When it comes to qualified education expenses, the third line here, it's a much narrower definition of educational expenses with the Trump account than it is for the 529. We spent some time earlier talking about all of the things that have been added in terms of qualified expenses. So if you are at all concerned about, that money not being used for traditional college, the 529 plan gives you more flexibility here. You also get more in the way of investment options. You might be looking at the Trump account column here and say, well, I don't mind the idea of a low cost US stock index fund. Sure, there are benefits to that type of low cost investment. But again, as you get closer and closer to college years, you probably want it to be more conservative. So again, the 529 plan makes it easier to do that. Not to say you can't put money in a Trump account and then use it for education, but it's a little clunkier, to use a technical term. And I just think, it's interesting. There was a good Wall Street Journal article just this week saying what types of accounts should you fund in what order for a child, and they actually said the same type of thing. Take the free money, sign up for a Trump account if you have a newborn, get the free money, but then wait to put your own money into it until you look at other things, including 529s. So.
Mhm. Yeah. So great advice. I think here when I look at this chart, the top line, the fact that there is so much flexibility built into a 529, the ability to change between bennies. People have asked some questions here about, hey, can I just fund my account for the youngest child and I can move money to other children, as needed if they have older children? Yes, you could use that as a strategy. 529 allows that flexibility, and you as the owner of the 529 always maintains control of that account, right? When you compare that to a
Mhm.
Trump account, there's really no access before age 18. It's limited strictly to that Benny, and the child gets full control of the money at age 18, right? Which, as we
Yeah.
know, that might not be a great thing for an 18-year
Yeah.
old.
Yeah, it might work out okay. It might not, right? I mean, lots of uncertainties in life. And, as I hear myself talking about, how great 529s are, I should mention, in addition to the fact that, yes, I work for a company that does 529s, I use these myself. I set up my first one when my oldest one was young, only a few years after they came into being. They helped fund my kids' education. They're all graduates now. I'm very thankful in many ways. But yeah, I've used it myself, and it's not just professionally, it's personally that I think they're a good way to go for a lot of people.
Great. And I can say the same thing. My three all had 529s, and very thankful that I knew about them very early in
Yes,
the process. So.
excellent.
All right, so now we're here to the Q&A section. Again, I'll thank everybody for the volume of questions. I know I won't hit every single one of them, but I'm going to try to hit some general themes in here in terms of what people are asking. Here's one that says, if a 529 is opened in one state and it underperforms compared to what's happening in another state, can the funds be moved to another state's 529 without penalty? Roger,
Yes,
yeah.
yes. And I haven't had to do it, but yes, that is possible to do that type of transfer. Yes.
Right, and that's referred to as a rollover, just so people know, and that
Okay.
is that is not a taxable event. You are free to move that money over to roll it to another state. One I will point out, you do want to make sure that the former provider gets your contribution amount and your earnings over to the new provider, because that tells what you've put in versus what your account has earned. Very important for tax purposes if you should ever have to take a non-qualified disbursement. So just keep that
Yes.
in mind.
Yes. Or the scholarship situation. Yes. Yep.
Yep. Somebody has a question that says, will you cover 529 able accounts? No, we're not going to do it during this webinar. Able accounts act very similar to 529 accounts, but it is a different section of legislation. There's a lot of special things there involved in terms of eligibility. I would point that person to Saving for College. We do have lots of able articles there that are useful and maybe useful for you to read and get up to speed on them. Another question about how much can you withdraw from a 529 plan for a child's elementary school fees? And that's one of the provisions that's actually gone up, actually within the last year.
Yeah. So now that's 20,000 per year, and I believe it's still tuition and limited expenses. Room
Yeah,
and
well,
board would
yes,
not be
yes.
there, right?
Yeah, yeah,
So,
it's tuition, but again, the OBBB last year expanded the use to actually some tutoring fees and
yes.
test prep fees and things like that. So it is very broad for elementary school now, K through 12 in general, not just elementary, but K through 12 is much broader than it used to be. So it's a good benefit. Uh,
Yeah. Yeah, and it's interesting because I think you do have to pay attention to the details in some of these cases, and I've gotten questions in the past about test prep fees versus like a college counselor fee, kind of a college coach. I think the latter, not likely to be a qualified expense, but the test prep, yes. So yeah, you do want to do your homework and look up the details if that's something that you want to take the money out for.
yep. Somebody's asking, is there a listing by state of the returns on various programs? And I'll put in a self plug there for Saving for
Mhm.
College. We have both listings of the performance of different plans, using kind of a similar scale in terms of one versus another. And then we also have a list of 529 ratings, which is a much more comprehensive view of 529 programs, also talking about the features that they offer and how easy they are to use and the quality of the management. And I will say that the T. Rowe Price 529 has scored very, very well on those ratings as well, just because it is such a complete plan with a really good gifting platform and other things that are real beneficial to the investor.
Well, thank you for that. And I'll give you a plug back that I used savingforcollege.com before I was ever in the industry. It's a great resource. So,
That's great. That's great to hear. Thank you.
mhm.
Let's see. Is there a slideshow available? Yes. Everybody will be getting a link, and that link will include, a replay of this webinar and a survey which we would like you to answer. Let's see. Um, if we're moving from one state to another, how many times can we move a 529 account? Um, Your rollover is you're not allowed to roll over more than once per year. So if that shouldn't be a problem, otherwise you're moving an awful lot. I think that's essentially for that beneficiary, you can move them over once per year. Let's see. What would be the best way for a child to take some money out after they're finished with schooling? With the least amount of fees and taxes. That's very open-ended. Um,
I would say kind of the most common uses would be one, you could use it toward student loan payments if they have them. That's kind of a straightforward usage. And again, if you've kind of exhausted every other possibility, or like siblings, other beneficiary changes, the Roth rollover is a certainly a nice fallback for up to that $35,000 lifetime.
great. Do grandparents' contributions are they required to report that on the FAFSA, a grandparent's contribution? Maybe this refers to the loophole that was eliminated, Roger.
I believe the answer is no there.
Yes.
I think the intention of the changes in the financial aid calculations in recent years has been to simplify it more and tie the numbers more directly to what the government can verify via tax returns. And so I think in that's part of why the grandparent uh, situation has changed. So I'm not aware of any requirement to put that on the FAFSA. Is
Right.
that your understanding too, Scott?
Yes, that is my understanding, is that the grandparents dollars or it's one generation away, so there's no logging of that information. I mean, they've changed the FAFSA. I'll say this in general for those worried about money coming out. The FAFSA now kind of automatically goes and looks at a prior year tax return. So it's a lot less of the filling in the form that it used to be, And now the IRS is actually going and taking the information from a prior year tax return. So they're not going to find, grandparent 529 program by looking at the parent's tax returns. So they've changed that process. All right, we're getting close to closing here. I see a final question here about, is there a place or a website that shows types of investments each state allows? Yes, again, Saving for College is a good place to go. We will tell you what type of investment choices that are there, and I'd highly recommend it to go there. And again, I'll remind everybody of that AMP bonus that is available on the T. Rowe Price 529, and you go to troweprice.com. I'm sure you'll find information there if you are interested in enrolling an account. Um, but other than that, I'd like to thank everybody for attending. I'd like to thank Roger. I think we really enjoyed doing this webinar. Please wait for your email. You will get a link to the presentation. You will get a survey, and we hope you enjoyed it. And happy 529 Day to everybody.
Thanks, Scott, and thanks, everyone.
All
Enjoy it.
right. Thank you.